Hi, this is Frank Bridges. I want to welcome you to today's SDRAFocus webinar on prohibited transactions. It's April 15, 2014, and appropriately enough, we'll be talking about some excise taxes involved in the prohibited transactions as part of one of the consequences. Today is actually the first in a series of 3 about prohibited transactions. So today we're going to be talking about when is a transaction prohibited and what the consequences are, both for excise taxes and otherwise. On May 20th, 2014, which is the 3rd Tuesday of the month of May, we'll be talking about what is a planned asset, which is one of the important and key ingredients to determining whether a transaction involves a prohibited transaction. So we'll be talking about the planned asset rules and why that's important for people who manage companies that have IRA investors. And then on June 17th, also the 3rd Thursday of June, we'll be talking about who is a disqualified person, because although the initial definition of that is fairly simple and straightforward, once we get into different types of entities that can be disqualified persons and the consequences and rules, fairly complicated rules or complex rules involved in that, it can get fairly confusing. So we have 3 scheduled explanations of prohibited transactions as part of our webinar series. June 17th will be the last of the season for this year. We'll be starting up again in September of 2014. So we're glad to have you listening, and we'll be moving along. So there are 3 required elements of a prohibited transaction, and you'll hear me refer to the word PT for prohibited transactions. The code provides that there are 6 particular types of transaction. We'll go over those briefly. And those transactions, if they occur directly or indirectly, end up being prohibited transactions. The transactions have to involve property of a plan. And in the case of an IRA or SILOK, those are assets of the IRA or SILOK. And then the transaction has to be between a plan and a disqualified person. So those are the 3 elements. Those are the 3 different types of things we'll be talking about in the 3-part series. So, and then of course there are consequences to a prohibited transaction, and there are 2 main ones which we'll be talking about today. One is the excise tax under Section 4975 that has to be paid by disqualified persons who participate in it. And the second, of course, which most everybody knows about, is that the owner is exempt. The IRA owner is exempt from that tax if the IRA is disqualified under Section 408. We'll talk a little bit about what that means. So then the second consequence is that the IRA account is disqualified if the IRA owner or a beneficiary engages in any transaction prohibited by Section 4975. And that's the provision in Section 408. So let's talk about the types of prohibited transactions. There are essentially 6 types, and I have them in 2 different types of category. The first 3 are the traditional types of transactions that people enter into in the business context every day. The sale, exchange, or leasing of property between people, loans or extension of credit, and the furnishing of goods, services, or facilities. Those are all primary types of prohibited transactions. Then there are certain prohibited transactions that are described in the code that are more easily understood as conflicts of interest. These come essentially from the context of ERISA, but they have special application to IRAs and SILOKs in the self-directed retirement account area. And so there are 3 rules. They're called the personal benefit rule, the self-dealing rule, and the kickback rule. So we'll talk about those. So the traditional primary issues relating to transactions, the loan or extensions of credit, the sale, exchange, or leasing of property between a prohibited disqualified person and a plan, etc., can occur directly or indirectly. And indirect is going to be a really important part of our discussion when we talk about the disqualified person issues relating to entities that can be disqualified persons. So I'm going to forego a little bit about that today. But just remember that any kind of indirect transaction can occur and also be a prohibited transaction. So in particular, loans and extension of credit end up being a particular interest to self-directed retirement account owners, and so I'm going to talk about those a little bit more in depth than the sale, exchange, or leasing of property, and we'll also be talking a little bit more in depth about services. So obviously, if an IRA owner loans money to his IRA, that is per se a prohibited transaction. There is, of course, an exception to that, which we'll talk about. There are almost exceptions to almost every rule here, but that's the way things are in the self-directed area. Then, of course, the IRA owner's guarantee of a business loan to an IRA. So I've had clients call me up and say, I've got a mortgage on a piece of property that my IRA owns. We took the mortgage out, and the mortgage was without recourse to me, so I didn't have to guarantee it. But now there's been a problem with the property, there's been a fire, we have to rebuild it, and I have to get new financing, and I have to get financing from the bank, and I can't get non-recourse financing. Can I guarantee the business loan? And the answer, of course, is no. That is a direct conflict with the prohibition of loans to IRAs. Guaranteeing the loan is a providing of a credit facility, and so and the Labor Department has held that. It's fairly clear from the statute that that would be prohibited. One thing that people have often discovered to their chagrin is that if they establish an account with a broker-dealer to buy and sell securities on behalf of an IRA, and there is a margin provision as part of that arrangement with the broker-dealer, typically the IRA owner ends up guaranteeing as part of the paperwork the margin account. This can happen, for example, if you have a self-directed retirement account that's invested in a single-member LLC and you have extra money lying around and it's not invested, so you want to make it work. And you open up a brokerage account with a broker-dealer or a registered investment advisor. But with a broker-dealer, you end up having a margin account so you can borrow against the holdings that you already have, up to, let's say, 50%. The paperwork can include in it a guarantee provision that says that the owner of the IRA or the individual who is applying ends up guaranteeing that margin. So providing that facility can be a prohibited transaction. So the distinction that we would make is if, even though it's in the paperwork that you are a guarantor of the margin borrowing, if you don't actually borrow any money, you probably have not, at least it's arguable, that you have not committed a prohibited transaction because there actually has not been any borrowing. I had a client call me up once and say, I did this, I didn't realize it had a margin account, then I discovered that I was the guarantor of the margin account, what do I do? So we argued that the margin account, just because the margin account provision was there, it didn't mean that there had actually been a prohibited transaction, since the margin credit facility was never used. And then the IRA owner can loan money to an IRA to meet a call. So, for example, if we have a single-member LLC or a multi-member LLC, let's say there are 2 or 3 or 4 people in the LLC, and one of them is a self-directed retirement account, and the LLC needs additional capital, the IRA, being a member, has an obligation to come up with the additional capital. And so that can be a difficult problem if there's insufficient funds in the IRA to actually come up with that money. So it's important to make sure that the IRA has reserves to come up with that. But if there really aren't any insufficient funds, sometimes IRA owners feel compelled to actually loan the money to the IRA to meet that call. So is that a prohibited transaction? Well, based on the statute, that would be a prohibited transaction. But there is an exception to that. The Department of Labor, who has administrative authority over establishing exemptions, it's also included in the statute, and prospective rulings about what's good and what's not under Section 4975, have established the Department has established a regulation that says that an interest-free loan by a retirement account member or by a plan sponsor for the payment of ordinary operating expenses of the plan, including the payment of benefits in accordance with the terms of the plan and periodic premiums under the insurance or annuity under an insurance annuity contract, or for a purpose incidental to the ordinary operation of the plan. So let me give you a little bit of history on this. Originally, only the first part of this exception was included in the regulation, and the purpose of it was so that, let's say that you had an ERISA plan and it was time to pay benefits to IRA owners, but the plan's investment were temporarily illiquid. Let's say that the trustees had to liquidate some securities in order to make the distribution, and the securities hadn't been liquidated when the distribution was required. So the regulation, this actually was adopted in the 1980s, permitted the plan sponsor to actually loan money in cash for a period of 3 days, up to 3 days, in order to bridge that cash flow problem. And so that was subsequently elaborated on a couple of times, and gradually that 3-day limitation has disappeared. And so now the department has added on the extra provision that says it is allowed for a purpose incidental to the ordinary operation of the plan. So we always wonder, of course, what that is. This change in the regulations occurred just a couple of years ago, so there haven't been too many interpretations, either regulatory or case-wise, as to what that exactly means. But I assume that one could actually apply to the Department of Labor if one was in that circumstance for an advisory opinion in order to determine whether you could actually make that loan and whether the purposes for the loan were actually incidental to the ordinary operation of the plan. So in our case of a call, for example, if the IRA had to meet the call, but it was in the process of transferring funds from another IRA, traditional IRA account, for example, at a Fidelity or a Morgan Stanley or whoever that might be, and that was going to take several weeks, but the obligation was now, I think that one could argue that a loan by the retirement account owner to the plan would be for a purpose incidental to the ordinary operation of the plan. It's so similar to the original purpose of the exception. So, there may be situations where we can actually loan money. It has to be interest-free. It has to be documented by written documentation. But that is a possibility when we're in a jam and there are liquidity problems, or the investment might be jeopardized by a breach of the obligations of the retirement account. So then, of course, there is always the question of furnishing goods, services, or facilities, particularly services. We get questions about providing services in the context of self-directed retirement accounts by disqualified persons quite often. So what does that mean? The statute says that you can't provide services to the plan, but there's an exception. Again, there's exceptions to every rule. There is an exception in the statute itself that says that reasonable contracts or arrangements with disqualified persons for office space or legal, accounting, or other services necessary to establish or administer the plan for reasonable compensation is okay. Except there's another provision, and here's the exception to the exception. that says in particular that IRAs, that's IRAs and Roth accounts, cannot provide, their retirement account owners cannot provide those services under that exception for reasonable compensation, for any compensation at all. So any services that would be within this definition of the exceptions by the IRA owner or a disqualified person would have to be without compensation. So what is necessary to establish or administer the plan? IRS has issued some regulations, and here's what it says. It says that the service has to be appropriate and helpful to the plan, obtaining the service and carrying out the purposes for which the plan is established or maintained. A disqualified person providing such service to a plan may furnish goods which are necessary for the establishment or operation of the plan in the course of and incidental to the furnishing of such services to the plan. So what does that mean for appropriate and helpful to the plan in carrying out its purposes? Well, so here's what's necessary to establish or administer the plan. It's essentially what the real question is. And so I would say that those, my general guiding principle, and there hasn't been a lot of interpretation of these provisions, would be that it's those things that a person who establishes a trust would do to place it in existence and make sure it is administered correctly. So, you know, if you create a trust yourself, you're the trust maker or settler of the trust, you set the things up, make sure that it has an account, for example, the trustee is appointed and accepts the appointment, etc. Those are the things that plan sponsors, employer plans often do to set up their plan. And second of all, are these things that the trustee of a trust would do in administering the trust itself? So let's take some examples. If we had a regular custodial account in any broker-dealer, it's not a self-directed retirement account, that's on the left side of the screen, we would be choosing who the custodian is, we would be choosing investments, and we would be choosing, potentially choosing an investment manager who would potentially negotiate an equity deal that the broker-dealer, for example, is offering to us. The broker-dealer might, or the investment manager or a registered investment advisor might collect dividends for the account. And if there are technical problems with the platform, then those issues might be fixed by the manager. Those are the things that traditionally occur when we have an individual retirement account, or frankly any kind of an account. We choose the custodian, we choose the investments, or if it's a plan at work, like a 401k plan, the trustees have been chosen and they choose the custodian, but we have the ability to choose the investments. Some plans actually allow, some employer plans, 401k plans, actually allow the individual investors to do self-directing investments, and that's gradually becoming more and more available to people because it can be done. So in the self-directed retirement account context, well, okay, we should be able to choose the custodian. So in the case of everybody who's on this explanation, they have chosen Pensco Trust Company to be the custodian. They don't have to choose Pensco Trust. They could choose several other custodians, but typically all of our clients are choosing Pensco Trust for specific reasons. And you know, we can also choose LLC ventures that we're going to invest in, or choose loans that we're going to make. So let's say that we have an LLC that's a single member LLC, and the IRA owner is the manager. He's providing those settlor trust, those settlor functions. He's acting as a fiduciary, deciding what investments the LLC is going to make, but he or she is not compensated. So the investment is made, and a dividend check or a distribution check comes to the LLC. How does that check actually get to Pensco? Well, somebody has to send it. Or if the IRA has purchased a piece of real estate, which can be done in various different states, and the tenant sends a check to the custodian, the tenant is going to write a check to the custodian, but is going to send the check to most likely to the IRA owner, who then will deposit it with Pensco, because the IRA owner doesn't really want the tenants to know what account they have at Pensco. So if the IRA owner receives rent checks, they're going to send those checks to Pensco. That should be okay as a fiduciary service necessary for the operation of the plan. And if there are repairs that have to be made and we have to hire someone else to make them, then we should be able to instruct Pensco to send them a check, or to send a check to us so that we can hand it to the service provider, like the plumber in the building. So, or we can choose someone to act as a building manager. So what does that mean? Let's say we have an LLC. Can we pay the bills of the LLC that owns the building? Well, I would say that we could, because that's very similar to if we own the property directly. Can we receive and deposit rent payments? Well, that would be very similar to what I discussed for the direct ownership of a piece of property. Can we negotiate leases? Well, that's an interesting question, because if you're a lawyer, then theoretically you could negotiate the lease, but there are certain extents to which negotiating a lease can actually involve substantial services, which may be beyond what would normally be considered what a settler would do or what a fiduciary would do. So if we were going to hire a lawyer normally to negotiate a lease, it would probably not be appropriate for us to negotiate the lease ourselves. On the other hand, if all we're doing is having clients sign a form lease and there's not much negotiating involved in that, maybe just if we have the lease, we can give it to the tenant for signature and then send it on to Pensco for signature on behalf of Pensco. Well, we talked about receiving deposits for rent. What about collecting the rent if the tenant defaults? Well, that would typically be a little bit beyond what someone would do as a fiduciary, so one would normally hire somebody. And everybody's familiar with the example of you can't fix the toilets and sweep the floors. So I would typically say that those last four in that list are not things that we would consider to be settlor functions or fiduciary functions that would be allowed under the exception. So to do those things, we would normally hire an independent manager to negotiate the leases, or choose an attorney to negotiate a lease, or to collect the rents, and fix the toilets, and sweep the floors, so that that independent manager is not a disqualified person, and they can conduct those activities, they get paid for that, and that will be okay. So for IRA owner managers, it makes sense to allow them that they be able to exercise discretionary authority and control, making decisions and delegating authority on various different issues over the management or disposition of the plan assets. So if it's a single member LLC, the assets inside the LLC are plan assets under the various different rules. We'll talk about that a little bit more when we talk about the plan asset rules. But the management or disposition of the assets of the LLC as a business activity is typically what one would do if one had an IRA anyway. And it's necessary to establish or administer the plan, in other words, those settlor functions, and as long as it's done without compensation. So there is a second prohibited transaction exception, and this is number 10, and this is the receipt of by a disqualified person of any reasonable compensation for the reimbursement of expenses properly and actually incurred in the performance of his duties with the plan. Well, so what does that mean, properly and actually incurred? Can we reimburse ourselves for expenses that we incurred in connection with an LLC that we're the manager of? Well, the answer theoretically to that is yes. So those have to be direct expenses properly and actually incurred in the performance of the services. But the regulations also provide that an expense is not a direct expense to the extent that it would have been sustained had the service not been provided, or if it represents an allocable portion of overhead costs. So if you are are providing space, for example, for the administration of your retirement account, and you want to pay yourself some rent or reimburse yourself for the cost of keeping that office open. Well, if you have the office anyway and you still have the expense of heating it and lighting it, that probably would not be something you could reimburse yourself for. So, but what about travel expenses? These are expenses that people do incur because they travel on behalf of their retirement accounts to various different locations. I had a client tell me that they wanted to travel from Massachusetts to California to negotiate a deal on behalf of their single member LLC. And they were trying to figure out whether their airfare and their accommodations and things like that while they were in California could be reimbursed by the LLC. So that's a difficult question, because let's say that you've got a choice between going to Motel 6, which is the cheapest thing you can find, or going to the Ritz. Is going to the Ritz ordinary and necessary? Is it really necessary for that? Or is that really just a personal benefit because you like being at the Ritz? Can your air tickets be first class, or do they have to be economy tickets? Do you have to get a mid-sized car or an economy car? What about the gas and mileage? If it's a mid-sized car or a gas guzzler, can you reimburse yourself for all of the gas and mileage? Well, that's a really close question, and it's not really clear what that would be. Out-of-pocket expenses like FedEx and postage, of course, appear to be things that are fairly easily identified as reasonable and necessary, provided that the FedEx or postage doesn't include personal items that are being sent as well as items being sent on behalf of your LLC. So traveling expenses and out-of-pocket expenses can be difficult. So the result of that is I typically recommend that clients do not reimburse themselves when there's any kind of fuzziness about whether it's ordinary and necessary. And so typically people do not do that. There might be a question on the other side of that as to whether that would be an indirect contribution to the retirement account, but I think that that would normally be considered simply an out-of-pocket expense that would be deductible under Section 212 of the Code for the individual who's conducting the travel, and that's expenses and costs incurred for the preservation of assets held for the production of income. So those are traveling expenses are kind of difficult because of the ins and outs of what's necessary or not. Direct out-of-pocket expenses like postage and FedEx are fairly easy. So that concludes our discussion of furnishing goods, services, and facilities and what the ins and outs of that are. And next we come to the three different types of rules that I categorize as conflicts of interest. So what are they? Here's the statutory language. And the D, E, and F there are subsections of Section 4975C1. So any direct or indirect transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan is a prohibited transaction. That's what I refer to as the personal benefit rule. And then next, any act by a disqualified person who is a fiduciary whereby he deals with the income or assets of the plan in his own interest or for his own account. In other words, I refer to that as the self-dealing rule. Usually people understand the whole idea of self-dealing, and they don't want to benefit themselves from the assets that they hold as a fiduciary. And so that those general concepts typically apply in this context. And then third, there's the receipt of any consideration for his own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with a transaction involving the income or assets of the plan. And that's what I refer to as the kickback rule. So let's talk about some examples. So let's say that the IRA owner or solo K owner loans money to a venture in which the IRA owner or solo K beneficiary has an interest. And this would be a situation where the loan is not otherwise a prohibited transaction. So in other words, the ownership of the LLC is less than 50% by people who are disqualified persons. We'll discuss that more in terms of the who is a disqualified person later on in part 3, but keep that in mind. And this is really one of the main cases that has occurred in this context, called the Rollins case. Mr. Rollins was the trustee of his accounting firm's 401k plan. And Mr. Rollins had the opportunity to make loans from plan assets to 2 or 3 different ventures that held real estate. It was being held for investment, and there were certain expenses that needed to be paid, and the ventures needed to borrow money in order to make those payments. Interestingly enough, Mr. Rollins held various different percentages of each of the entities that he made the loans to, but he held no more than 26% of any of them. So his highest amount of the percentage that he owned in any of these ventures was 26%, and none of the other people who were owners in the ventures was a disqualified person with respect to the 401k plan that he was the trustee of. So Mr. Rollins said, well, okay, I think I looked at all the rules. It seems to me that the entities that I'm loaning to are not disqualified persons, so I should be able to make the loans. I'm going to make the loans at a rate that I think is reasonable based on the market for loans at this time. So he made those loans. Later on, IRS examined those and said, no, you couldn't do that. That's receiving a personal benefit. So what did they mean by that? What they meant was that as the owner of the entity that was borrowing the money, Mr. Rollins was receiving a benefit from the fact that the loan, to the extent that the loan was more advantageous to the venture than what was otherwise available from commercial lenders, like a bank. So if the loan from the retirement account or the retirement plan was at a rate that was 5%, for example, but similar loans in the market for loans in that area was at 6%, then Mr. Rollins was receiving a benefit of 1%. And that's what IRS claimed. Now, IRS did not have to prove in the context of this case excuse me, that the loans were not consistent with the market. Actually, Mr. Rollins had the burden of proof on the question of whether the loans were otherwise available at the same rate and on similar terms in the market for loans in that area at that time. But he didn't provide any evidence to that effect. He simply asserted it himself at the trial. And so what the court held was that Mr. Rollins had not met his burden of proof as to whether the loans were a personal benefit to him. In other words, to controvert the allegation by IRS that it was a personal benefit to him. And so Mr. Rollins lost, resulting in excise taxes, etc. So that was the personal benefit rule. Another kind of thing would be the self-dealing rule. So let's say that you have an investment that you want to make, and you've committed to making it. Let's say you've committed to buying a house, and then you discover that you don't have sufficient funds to actually make the investment yourself in cash or however that might be, and then somebody reminds you that you have an IRA that could supplement the funds that you have, and so you use the IRA funds in order to meet your obligation to make the investment, so purchase a piece of property, for example. Well, in that case, you've just used your IRA funds so that you could deal with a personal benefit. That you could deal with a personal crisis. So you've received a personal benefit from your IRA that is not one that's allowed. The only personal benefits you're supposed to get from your retirement accounts is distributions. So you've now leveraged your IRA in order to make an investment for yourself, and so you've made that possible. Well, that would be self-dealing, also sometimes referred to as enabling. Now, it's interesting, this rule is a very difficult one to distinguish between the following situation. Let's say that you find an investment opportunity that you want to include your IRA funds in because you think it's a really great investment. So you transfer your money from a traditional IRA custodian, you put it into Pensco, and you give Pensco directions to invest the entire account in the investment. It's a building or a partnership or something like that there are other partners in. And at the same time, your IRA, you've used up all the IRA funds that are available, and you have the opportunity to buy some additional part of the investment yourself. So you use some of your own money that's not IRA money, some of your after-tax money, to make further investment in the opportunity. Is that self-dealing? Well, one would distinguish that from the first example by the fact that the IRA was, you were including the IRA because you wanted the IRA to get the opportunity. And the fundamental distinguishing factor would be whether you could make the investment yourself without the use of the IRA funds, and if you could, then you're not really enabling yourself to make the investment. And so you're not self-dealing. You're simply giving your retirement account an opportunity that is not otherwise available to it in the investment vehicles available at the broker-dealer, for example. So typically when people ask me about whether they can co-invest with their retirement account, my first question to them is, well, could you make this investment all by yourself without the IRA funds? And if the answer to that is yes, whether they have a credit line on their house or whatever that might be, if they have the resources to do it without their retirement account, then typically I would say that is probably not self-dealing. But if they don't, and if they want to make the investment anyway, my concern would be that would be enabling the investment and using the IRA funds for your personal benefit to make the investment. Now, the kickback rule does not have a whole lot of applications, at least in my experience, in the IRA area, in the traditional self-directed retirement account area. The kickback rule essentially is a rule that relates to, it was derived originally from the old abuses in the early 70s by labor unions and other kinds of trustees who were making investments in various different types of investments or in a broker-dealer's account. And in exchange for making that investment on behalf of the plan, they were getting payments from the person who was receiving the investment money. So, that would be a kickback. Typically, that is not something that's going on with a self-directed retirement account, but an example of that might be if you had your own single-member LLC and you decided that you were going to open a bank account for the LLC, and it was the only owner of the LLC was your retirement account, and in connection with that, you were offered personal checking accounts outside of the LLC in exchange for having opened that account, then that might be considered what we call the kickback rule, and that might violate the provisions of the conflicts of interest under the statute. So let's talk a little bit about the consequences. So the first consequence, of course, is excise tax under Section 4975. And that is paid by any disqualified person who participates in a prohibited transaction, and that's other than a fiduciary acting only as a fiduciary, in other words, for no personal benefit or gain to themselves. But the IRA owner is exempt if the IRA is disqualified under Section 408. We'll talk about what that means. So typically, because IRAs do get disqualified because of a prohibited transaction, the excise tax under Section 4975 isn't often applicable in the self-directed retirement account context. But wait, let's say that you had someone else who was investing with you in a retirement plan or in a venture, and the venture itself went into a transaction that ended up being a prohibited transaction. The co-managers of the LLC could be someone, and let's assume that they have they qualify for the definition of a disqualified person. They could be someone who actually participates in the prohibited transaction. So they could end up, even though your retirement account is disqualified, being obligated to pay excise tax. And then, of course, the excise tax is important in the context of solo K plans that are in the self-directed retirement account area, and we have some of those. So, you know, the excise tax is really important. So let's see what that is. That's 15% of the amount involved, and that's 15% per year during which the prohibited transaction is outstanding, and that's for during the taxable period. We'll talk about what the taxable period is in a second. If the prohibited transaction is not cured within the taxable period, it's 100% of the amount involved, and that's a different excise tax. So theoretically, if you were someone who participated in a prohibited transaction and it wasn't cured, you could end up paying 115% of the transaction benefit. So that's a separate section under Section 4975. So this is imposed on any disqualified person who participates, and that's other than a fiduciary, acting only as a fiduciary. It's imposed on the value determined as of the date of the transaction, but the 100% excise is imposed on the highest value of the benefit during the taxable period. So you look at what the highest value of whatever it was that was involved in the prohibited transaction, and that's the one you pick for the 100% excise. So what is the taxable period? Well, that essentially is the period of time from the date of the prohibited transaction to one of three things actually happening. IRS sends a notice of deficiency. That would be one. The date on which IRS imposes the excise tax under Section 4975, or the date on which the correction of the prohibited transaction is completed. Hopefully the earliest of those is the date on which the correction has been completed, because if the correction is not completed on or before the time that you get your notice of deficiency, you're ending up exposing yourself to the 100% penalty. So we want to be able to correct the transaction, which means put the account back in the position it would have been without having made the transaction. Excuse me. So there is, however, an IRA exception, and that, of course, is that if there is an IRA owner who participates in a prohibited transaction, the IRA is disqualified, and if the IRA itself is disqualified, the IRA owner is exempt from the excise tax. Notice that the IRA exception does not apply to solo Ks. So what is the amount involved? Well, the code provides a definition of that as the greater of the amount of money and the fair market value of the other property given to the disqualified person, or the amount of money and the fair market value of the other property received by from a disqualified person. So, you know, the plain reading of that, without actually thinking about it too carefully, would be, well, if I made a loan of $100,000 that was a prohibited transaction, then the amount involved would be the $100,000. But actually, that's not the way this provision is interpreted by IRS or by the Department of Labor. Notice the use of the word the other property given, or the amount of money and fair market value of the other property received. Well, the IRS actually has a regulation that defines that as the greater the amount paid for the use of the money or the fair market value of such use. In other words, it's not the principal that was involved in the transaction, It's the amount of money that one would charge for the use of that money. In other words, it's sort of like interest. So if there's a loan that's made and it has an interest rate, then the amount of money that's charged on the interest would be the amount of money that's involved, not the principal of the loan. So, and also please note that each year the transaction that is not corrected is a new violation. So you get to get the excise tax every year that the violation is outstanding. So now let's talk about what happens when the IRA account is disqualified because the IRA owner or a beneficiary engages in a transaction that's prohibited. Well, okay, the account is disqualified as of January 1st in the year that the transaction occurred. So for the traditional IRA, the entire value of the account is ordinary income for that year. And for a Roth IRA, because the Roth principal that's contributed is after-tax money, it's the accumulated earnings over the account basis that's ordinarily the ordinary tax income for that year. So what happens is of course, is if the account is disqualified, it's also no longer qualifies for the exemption from claims of creditors under the statutes. There's a number of cases that say that if an IRA is subject to a state exemption, and there are other provisions that say that an IRA is exempt to a certain extent under ERISA, then because the IRA is disqualified, the account actually loses its exemption from claims of creditors, which is not a good thing, and we'll see why. A typical example of this whole problem is the case of Ellis versus Commission, which we discussed last fall. Remember, Mr. Ellis had retired from, made early retirement from a business in which he was a manager or a chief executive officer. He had a fairly large retirement account. He rolled it out to an IRA and decided that he was going to put it into a self-directed retirement account and start a used automobile dealership, used car dealership. So he established the account and he established something called CST LLC and made the investment, receiving 98%, actually it was $998,000, or I'm sorry, 998,000 units of LLC units for his IRA. And so the problem was that he also appointed himself as the general manager of the dealership, and he paid himself a salary. Now, if he'd just been the manager of the LLC and had not paid himself and had done only fiduciary or plan sponsor or settlor functions, he might not have gotten into this jam. But he appointed himself as the business manager, and he paid himself the salary. So that was in 2005. Several years later, he got audited. Actually, what got audited was the used car dealership, and that led to an audit of the investor of the IRA, and then the bells started ringing for the IRS agent. So what happened? The IRS said, well, this is a prohibited transaction in 2005, and so you should have paid tax on the entire value of what you invested in CST, and you didn't pay tax in the year when you should have done it, so you owe interest and penalties over that period of time. So the court said he used his IRA to establish the business, and it was his primary source of income. In other words, he was getting a personal benefit, he was providing services to his retirement account, and that's a prohibited transaction. His role as the general manager was not for the administration of his IRA or for the management of its investments. It was not a settlor function. And his IRA was disqualified as of January 1st in 2005. So when did this court decision happen? It happened in 2013, which is 8 years after the disqualification of the account. So what happens to Mr. Ellis? He owed income tax on $321,345.25 because that's the amount that was invested in the account in CST, and he received that as a distribution as of January 1st in 2005. He was still under 59.5 when that happened, so he got to pay the penalty tax of 10% for premature distributions. And because he had all of this income in 2005 that he did not report, it was 20%. He actually reported his income more than 20% less than what he actually incurred, so he had to pay penalties for underreporting his income, and he had to pay interest on the unreported taxes and penalties for 2006 through 2013. So how does that all work out? So let's take a look at an estimate of what the disaster is for Mr. Ellis's tax obligations. I don't really know what his tax bracket was. I don't really know what the interest rates were for the period of time, and it does change over time that are imposed. But here's what it is. He had taxable income in 2005 from his IRA disqualification of $321,345.25. Let's assume that he was in the 35% bracket at that time, so he should have paid an extra $112,470.84 when he filed his income tax return in 2006. In addition, because he received the distribution early before he was age 59.5, he had a 10% penalty of $32,134. And so the total of all of those taxes is $144,605.37. Well, okay, so he should have paid those in 2006, but he didn't. So between 2006 and 2013, he has to pay underpayment penalties at the rate of 0.5% per month for the whole 8 years. If you run the numbers, that calculates out to $69,410.56, which is essentially about more than half of the amount of the taxes. He also had to pay interest on the unpaid taxes for those 8 years. Remember, the first one is interest on the underpayment penalty, or interest on the taxes and underpayment penalty. And then he pays interest on the taxes themselves. The interest rate that he pays on the taxes themselves is a little bit different, and it's quite a bit lower because the tax on the penalties is actually about 12%. I'm sorry, is 6%. But he also had to pay a tax at the rate of the applicable federal rate plus 1%. So I assume for purposes of this that it was 4% a year, and that's compounded monthly, and that, if you calculate it out, comes to $4,701.41. So then he had, of course, because he had disqualified his retirement account, all the income that he got from the retirement account was taxable to him during that period of time. So if you take 35% of if you take 2.5% of the total amount that's in the account of the $321,000, multiply that by 35%, and I'm assuming that the return rate, the income tax rate, the return of dividends and interest was 2.5% in the account. That was 35% of that over the 8 years was $23,894.17 for a total tax benefit or tax burden of $242,611.53. But wait, that's not all. Of course, he had the penalties and taxes, but now, because the retirement account has been disqualified, he has a potential for losing the account if someone is a creditor that comes along. So if he loses the account because he has creditor claims, he loses $321,345.25 to the creditors. Let's say the bank decided that they wanted to foreclose on his used car dealer, and he was a guarantor. Of course, that would have been another prohibited transaction. Or if he had another transaction that he was involved in, and he guaranteed some kind of a purchase of a piece of property, and it wasn't related to his retirement account, now the account becomes part of his assets, and his creditors can get to it, so he stands the chance to lose the $321,000. Well, if he loses the $321,000, he ends up losing, and let's assume that there's a total earnings rate of growth and income of 6% for another 10 years that he was planning before he retired. So if you calculate that out, that's another $192,807.15. And by the way, that's without compounding. So if you add up all of the potential loss that Mr. Ellis had, because he had this prohibited transaction, his retirement account was disqualified, you come to $756,763.93. A potential disaster for Mr. Ellis. So, the real problem with prohibited transactions in retirement accounts is that they often occur and the retirement account owner doesn't know that he or she is disqualified his or her plan. And that's the reason why we try to make sure that our self-directed retirement account SDRASafeguard members get educated so that they can recognize when there's a potential for a disqualification before it occurs. So I hope that if you have any questions, you'll certainly call to ask them. And remember, you have the first call privilege. You can call, and the clock doesn't start unless it turns into a project, and we'll talk to you about that. But if we can answer the question based on our experience, that we'll do that. That's part of the program. So feel free to call us if you have any questions along these lines. So thank you very much. I'm happy that you were able to listen to this and watch this presentation. And I look forward to seeing you at part 2 in May. Thanks very much.